Okay, so what did we talk about last week? What were the key takeaways? There's three main financial statements, right? The first is called the Statement of Financial Position, also known as the balance sheet, and that'll show all the assets and liabilities and shareholders' equity of the company. And it's at a point in time, right? It's as of today, May 5th, usually December 31st. Okay, it's a specific point in time. It's how much cash is in the bank at that time. How much equipment do you have at that time? How much bank debt do you owe at that point in time? What's an asset? An asset is something owned by the company that will provide future economic benefit. Your laptop is an asset to you because hopefully it'll last for the next 3 years, right? Your cell phone bill, when you pay it, is not an asset because you pay the bill and you don't get anything in the future for it, right? You paid it for past service. Okay, so that's the difference. Assets are expected to provide you with something in the future. What's a liability? A liability is the opposite of an asset, and liabilities are expected future cash outflows. You still owe the bank $10,000. You will owe the government of Canada for OSAP $5,000, $10,000 when you graduate, right? Those are liabilities because you will at some point have to settle those in cash. Both assets and liabilities have to have resulted from a previous transaction. Something has to have happened. Okay? The anticipation of something happening in the future does not necessarily, for our purposes, give rise to an asset or a liability. Thinking about buying your MacBook doesn't mean there's an asset on your books, right? And the third component is shareholders' equity. Shareholders' equity, you can think of it in two ways. The first is it's the difference between the assets and the liabilities. If the company has $100 of assets, and if you were to sell all those assets today and pay off all the liabilities, let's say there were $60 of liabilities, the shareholders, us, we get what's left, the $40. The second way to think about it, and it will get you to the same number, is how much money did the owners put in as common equity? We'll say we put in $30. Plus, how much has the company earned over time, the retained earnings? And that belongs to the shareholders as well. The accumulation of assets results in the increase in shareholders' equity. I was talking to a student after class last time, and this is an example I wanted to bring up. Think about a house. Let's say the house is worth $1 million. Okay? If you wanted to buy the house, you likely need to take on a mortgage from the bank. But if you put $200,000 down plus an $800,000 mortgage, the house is worth $1 million. If you go to the bank and get a $700,000 mortgage and you put $300,000 down, the house is still worth $1 million, right? How you finance it, the mix between debt and equity, doesn't impact the value of the house. Okay, the previous owner of the house, the person you're buying it from, doesn't really care how you pay them for the house, as long as you get $1 million of cash somehow and give it to them. So that's the difference, right? And over time, as the mortgage gets paid down over the 25-year amortization period, the principal of that mortgage gets paid down, the equity increases, right? That relative allocation. No, the house, let's assume it doesn't change in value. The house is still worth $1 million, but as that debt decreases, that equity increases, okay? The other thing is, remember what our perspective is here. We are investors. Investors, for the most part, have one goal, and that's to make more money. So they'll invest their money with the hope that the company will do well. Okay, so we're preparing financial statements for external users to make investment decisions. Okay, to make that decision on do we invest in ePhone or in Apple, and which company's better and why. Okay. So, Chapter 2, Investing and Financing Decisions and the Statement of Financial Position. Okay, so we can what business activities cause changes in the statement of financial position? So remember, the statement of financial position shows our assets and our liabilities. What sort of transaction might impact the statement of financial position, okay? How do these activities affect each balance? We're going to go in detail to understand these transactions. And how do companies keep track of the amounts in the statement of financial position? If you're Google, you have 1 million transactions every 10 minutes. How on earth do you keep track of that, okay? That's what we're going to go over. All right, so this is a little theoretical. What is the objective of financial reporting? To provide useful economic information to external users for decision making and for assessing cash flows. Okay, so we are external users, right? We can decode this a little bit. Useful economic information. What's the difference between useful economic information and non-useful information? To know that ePhone has a piece of equipment worth $10,000 is useful information. To know that the color of the equipment is red as opposed to blue is not useful economic information, right? External users, that's us. Investors, banks, regulators. For decision making, what decision do we make as investors? Do we invest more or do we take out our investment? As a bank, do we extend credit to this company or not? Right? Regulators, do we have a problem with this company being publicly listed on our stock exchange? Are they using fraudulent accounting practices? And for assessing future cash flows, how much, so again, you as an investor want ePhone to do very well in the future. What does it mean to do well? It means it'll be able to generate a lot of cash in the future, right? Have you heard Apple has something ridiculous? They have like billions and billions of dollars of cash just sitting in their bank accounts, and they don't know what to do with it. They have too much money, right? That's a sign of a good company. They generate a lot of cash flow. So what are some qualitative characteristics? What are qualities of these financial statements? Relevance. This has to be relevant to the decision you're making. Faithful representation. What does that mean? It means you're not lying. There's no error or fraud. If you're a CFO, Chief Financial Officer, and you unfaithfully represent certain numbers because you want to hit your bonus, that's not a qualitative characteristic of useful financial statements, right? That diminishes the usefulness if you're lying. Comparability. Statements have to be comparable to each other, to other companies at the same time, and to itself, to the same company over time, right? That's why you need consistency. Verifiability. An external party has to be able to verify the amounts on the financial statements. And what does it mean to be able to verify those? Well, if the company says a transaction occurred, we made a sale to a customer for $100, you as an investor should inherently be skeptical of any company that doesn't have an auditor, a third party, to say, yes, we've checked that number. How would you check that number? Well, a third party auditor would be hired, and they would actually look at the invoice. And they'd say, can we see the invoice that you sent to the customer? And can we see the cash that the customer sent you? And can we see the shipping log that shows you shipped out a phone to them? Okay, they'll check the records to make sure that these amounts are verifiable. If you say, oh, there's no invoice, that's a serious problem. That number is not verifiable and the statements are not as useful. Timeliness. If today Google released their results for 2001, who would care? Nobody, right? It has to be released in a timely manner. Usually you have only 90 days from year end, maybe 120 days from year end. So if your year end is December, that means by the end of March you need to have financial statements out. That's a pretty short period of time. Okay? But investors, the quicker you can get the information, the better. Understandability. The statements have to be clearly laid out and understandable. Understandable to a trained party. Doesn't need to be understandable to the layperson, but after you've taken AFM 101, financial statements should be understandable to you, meaning you can read them. If they're laid out all messily and they're using like Comic Sans font and the notes come before the financial statements, that's a serious problem, right? They're not going to be understandable. Nothing new on the elements of statements. We've seen these before, right? Assets, liability, shareholders' equity, revenues and expenses. We'll go over gains and losses later. So this is just definitions of those qualitative characteristics. Okay, so this is sort of accounting theory, not very interesting, kind of abstract, but this underlies all financial statements. This is the theory behind why all financial statements you look at will look very, very similar, and there's a reason for that, right? There's a reason auditors exist. Auditors get paid millions and millions of dollars to do this every year. There's people who all they do for their entire career is audit other companies. Okay, so there's a lot of demand for this. So it's not, this isn't just academic, this is practical. Yes? Yeah. Good question. Yeah, good question. So the question was, For timeliness, let's say you're not a publicly listed company. So if you're a publicly listed company, meaning you have shares traded on the NYSE or the TSX, they mandate you have to have your audited financial statements released 30 days or 120 days after year end. If you're not publicly listed, the question is, what are your reporting restrictions? Usually, if you have bank debt, which a lot of private companies do, the bank also mandates you give them audited financial statements 90 days after year end. Why? Because the bank cares just as much. If there are signs that you're in financial distress, the bank wants to know. And they'll squeeze you a little bit. They'll say, you need to pay us more money up front, or we're not going to extend any more credit, right? So if the bank doesn't have any requirements, there's no legal, the government of Canada doesn't say every company must release audited financial statements. If you're a private company, if you're a contractor, you don't even need to have an audit. Owners of companies, private companies, sometimes do want audited financial statements because sometimes you uncover fraud. It's good to know how you're performing. You might be a great businessman, but not a great accountant. You might want to make sure that all your accounting records are in order and that you're accurately being able to assess your company's performance, even if you're private. If you're private and you plan to go public in the future, you're going to need audited financial statements. Okay, so companies in anticipation of going public in the future or in anticipation of getting bank debt will often want to be audited 2 years before they plan to go public, so that the public markets say, can we see statements going back more than just a year, right? They want to see some history. So there's numerous reasons why, even if you're not yet publicly listed, you'd want to have or need an audit. Okay, more abstract concepts. The assumptions underlying all financial statements are this: separate entity. The company is a separate legal entity from its owners and from its shareholders and from its creditors and from its managers. Okay, the company in law exists as a separate person. Okay, companies historically are set up for the purposes of limited liability. That means the company can get sued. You as shareholders cannot get sued. So if ePhone has been treating its workers unfairly and polluting the environment, doing all these things that typically lead to lawsuits, and it gets sued, and it has $100 assets, and it gets sued for $200, that's a serious problem, right? It might go out of business. Shareholders are not personally liable. The liability is limited to the corporation. Okay, that's one of the great advantages of having a separate entity. You as a business person, if you do not incorporate, you are personally liable. If you own a store and someone slips and falls in front of your store on ice and breaks their back and they sue you, there's nothing in between you and that person. You and the company. You are the company, okay? So, separate entity. Activities of the business are separate from activities of owners. Now, I talked about it from a litigation perspective, but when you and I trade shares with each other or with the Econ 101 class, that doesn't impact the company, okay? When the company makes a sale, that doesn't impact our day-to-day, our bank accounts, our personal bank accounts don't change, right? We're two entirely separate entities. We just happen to be the investors. Same for the bank, right? The bank, you can actually sell debt, right? The bank has money receivable in the future from this company. It can sell that to someone else. It doesn't impact the company. Okay, so there's two separate entities. Continuity or going concern. Now this language is actually counterintuitive. The word concern might make you concerned, but to be a going concern is a good thing. To be a going concern means you're expected to continue into the future. That means you have positive cash flows, you don't have too much debt, you're generating revenue, etc. So the assumption is that the entity will not go out of business in the near future. This is important because of how the financial statements are reported. We won't go too much into it, but if a company is nearing bankruptcy, the way you report their assets and liabilities changes. Okay. Unit of measure, no surprise there, National Monetary Unit, dollars in Canada. Another principle is historical cost. Okay. So when we go out to buy a piece of equipment for $10,000, it gets recorded on our books, on our statement of financial position at $10,000, which is the cash equivalent cost given up as the basis for the initial recording of the elements. Okay, I know it sounds sort of matter of fact, but one key fact is cash equivalent. That doesn't mean we have to pay cash for everything, but the equivalent of cash is if you send me a piece of equipment and I promise to pay you $10,000 cash tomorrow, that's cash equivalent. We'll see why this matters. We'll see some examples of this, so hopefully it'll become more concrete. Over here on the left side is just some definitions. These are a little bit more cryptic than I'd like. We'll go over revenues and expenses and gains and losses and the difference between them, okay? We'll do that later. Okay, so assets can be thought of broadly in two types. They're either current or non-current. Okay, current assets will be used or turned into cash within 1 year. Your MacBook would hopefully not be a current asset. You're probably going to use it for 2 or 3 years. Your phone, maybe that's a current asset. Inventory that a company has, companies carry inventory with the expectation of selling it in the near term, right? If ePhone makes last year's model, that's probably not going to move very quickly in inventory. So our goal with inventory is to move it very, very quickly. Okay, so inventory is a current asset, meaning we expect to sell it, turn it into cash, use it within a year. Non-current assets are long-term. They're also called fixed assets. They will be used or turned into cash over a period longer than the next year. If we buy a piece of machinery, chances are we're going to use that for 5 years in our manufacturing operations. That would be what's called a fixed asset. Okay. The classification here is important to assess what we call liquidity, and we get into that later. Here's some examples. So current assets or short-term assets, cash, of course. Cash is as short-term as they come. Short-term investments. If we're a company like Apple and we have a lot of cash sitting in the bank, we might want to reinvest it. We can put it into the stock market. We can lend it to other companies for short periods of time. Okay, we don't want this cash tied up for a long period of time. You can go out and buy a 10-year Government of Canada bond. The problem is you're locked in for 10 years, right? That's not very short term. So we might put it into a 3-month Government of Canada bond, right? Just to have it earning a little bit of interest income. Trade and other receivables. This is what happens when we sell to a customer who doesn't pay us up front. So we're ePhone. Let's say we sell to a retail store. Let's say we sell to Walmart, and Walmart's going to carry our phones. And Walmart says, we're not going to pay you in cash until we start selling some of your phones. So we sell the phones to Walmart, and we book what's called an account receivable. We've sent them the phones. We've earned the revenue for that. We send them $100 of phones. Our inventory goes down. We've earned revenue, but we haven't earned any cash. We have an asset on our books called a trade receivable, and it's current because we expect Walmart will pay us in the next 6 months, hopefully. But it's an asset because they're going to give us cash, right? If you loan money to a friend of yours, if you loan $500 to a friend of yours, hopefully you're going to get it back, right? If you were to sort of run your own net worth statement and see, well, how much money do I have? And you say, oh, well, Joe still owes me $500. You'd count that as an asset. This is the same concept, okay? Inventory, of course, any completed phones we have on hand that are going to be sold or in the short term. Prepayments. Expenses paid in advance of use. If you pay your rent for the year on January 1st for the entire year, you don't recognize the expense up front because you have the right to live in that space for a year. Every month that passes is when you sort of realize that expense, right? And we're going to get into more examples of this. But when you pay that money on January 1st, your cash balance decreases, but you have this asset, the right to use this apartment, right? The right to use 202 Leicester Street, that condo, for the next year. Your landlord can't kick you out without repaying you the money. You could sublet to somebody, right? And then they now have the right to use it. But you paid this cash. It's not an expense day one. It's only an expense through the passage of time. At the end of the year, December 31st, there's no more asset left, right? There's no future benefit to you because you've used your 1 year rent that you paid for. Same for a cell phone plan. If you do a 3-month prepaid cell phone plan, on the day you make that payment, that expense is prepaid. It's still an asset to you because you haven't used the cell phone plan yet, right? You still have 3 months of service left. You could sell it to someone else. Maybe you can call the company and get it refunded. You still have a future benefit for the next 3 months, okay? So payments made in advance of realization of the expense are called a prepaid asset or prepaid expense. What are some fixed assets? Property, plant, and equipment. And we'll get into this definition, cost less accumulated depreciation. Property, plant, and equipment, that's long-term manufacturing equipment and property that ePhone owns that we intend to use over a long period of time to generate revenue. I won't talk about these yet. It's kind of advanced. We don't need to get into that. So that was the asset side. Liabilities, very similar concept. It's just on the other side of the balance sheet. There's current and there's non-current. Current liabilities are those which we expect to settle in the next year. Okay? Accounts payable is a good example of this. So think of the reverse between Walmart and ePhone. Think of if we're Walmart. We received phones, we received inventory, which is an asset that we can resell. We still have to pay ePhone as our supplier when we collect the cash. The day we receive the inventory, we have to recognize a liability because in the future we will be paying ePhone cash. Okay? For the coming year, 12 months is the cutoff. Non-current liabilities are long-term debt. Maturities, debt maturity is when it expires, when it's required to be fully paid off. Okay? If you have a mortgage, a 25-year mortgage, that's a long-term liability, right? You're not paying it off in the next year. That would show up in the long-term or non-current liabilities section. So there's that example where Walmart, the day that ePhone recognizes revenue and an account receivable, Walmart is going to recognize an account payable. Walmart now owes money to ePhone, right? Short-term borrowings. Companies can borrow for short periods of time. You can borrow for 6 months, short-term loan. If you expect to repay that loan in 12 months, then it's a current liability. Income taxes payable. How do income taxes work? They're actually very complex, but at the highest, most simplistic level, a corporation pays tax on the profit it earns. So in Canada, the corporate tax rate is, we'll call it 15%. So if you earn $100,000 of profit in your corporation, the government says you owe us some of that. We provide you police protection, we provide you roads, we provide you courts, freedom from war, peace, etc. So you owe us 15% of your profits. So how the books typically work is you earned $100,000, let's say throughout 2016. The matching principle, remember revenues and expenses have to be matched. The expenses have to be matched to the period in which the revenue was earned. Okay? You incurred taxes in 2016, but you actually don't file your taxes until 6 months later because it takes time to get your books together. People are sometimes delinquent. So you might not pay your taxes until March 2017, June 2017. Okay? That you still owe the liability as at December 31, 2016. Because it's related to your 2016 profit. So you'll often see companies will recognize an income tax expense and an income tax payable. Money they owe to the government. They just don't know how much they owe. They're still figuring it out. They don't pay them for another few months. Okay, but it's related to 2016, which is why it's recorded as an account payable. In the non-current section, long-term borrowings, that might be your mortgage, right? Or your bank debt, right? If ePhone borrows 10 grand from the bank, if the bank says pay us back in 5 years, that's a long-term debt. Shareholders' equity, nothing new here. Financing provided by the owners. Okay, there's a few components. Contributed capital is the same as common shares. Okay, just a different word. Retained earnings, and we don't need to go into other components. Nature of business transactions, or the duality of effects. Most transactions with an external party involves an exchange where the business gives up something but receives something in return. This is not groundbreaking, okay, but think about our example with ePhone and Walmart. ePhone had inventory. It sold the inventory to Walmart to make a profit. Okay, so it gave up this inventory, but it realized cash. Okay, let's assume Walmart's going to pay ePhone in cash today. What's Walmart's perspective? Walmart gave up cash, their cash declined, but they got this inventory. They can now sell this hopefully at a higher price than they paid ePhone for it, right? External events happen between the business and one or more parties, right? So in this case, you can borrow cash from the bank. There's two parties involved. There's also internal events. If we incur fire damage, we're the only party affected. I mean, maybe our insurance will cover it, but there's only one side to this transaction, right? So there's two types. Okay, what are accounts? It's just an organized format used to accumulate the dollar effects of transactions. So what does that mean? Well, let me see what the next slide looks like. Okay, so before we go any further, I want you to think. So I've given you a lot of examples of transactions, right? And it makes sense conceptually. The question is, how do we actually translate this transactional information? We'll call it information, not digital information, because they've had accounting for thousands of years. How do they record this transactional information in a format that was readable and recordable? And I want you to think of computer programming. Even if you don't have any computer programming experience, what I want you to consider is this. You might know what you want the computer to do, but you need to tell it what to do in a way that it understands, right? There is only one way that a computer will accept your input, right? Your syntax has to be accurate. You need to have all the proper brackets and indentations and semicolons and variable declarations and all that, right? The same goes for accounting. It's luckily not nearly as complex as computer programming, but the concept is the same. You need to somehow, you know what you want the outcome to be. You know what sort of information you're trying to give this system, the accounting system. You need to put it in a format that it will understand. Okay, so there's a standard way of recording all transactional information for accounting purposes, and that's what we're going to go into. These are the mechanics, okay, the underlying workings of the accounting system. And even though now everything is digital, this is actually how the systems work at a very fundamental level. Okay? Oh. A chart of accounts is a list of all the account titles and their unique numbers. Okay, so why is it important to have unique numbers for every account? Oftentimes now in our digital systems, we identify account by numbers. Cash might be account 100. Accounts receivable might be account 105. Okay? If you have two accounts with the same ID, that's a problem. That's like you having the same student ID as someone else. You having the same email as someone else. Doesn't make sense. You can't have the same bank account as someone else, right? Everyone has a unique identifier so that the bank knows it's you. Waterloo knows it's you, right? The accounting system works the same way. Every account needs to have a unique ID. Okay? The chart of accounts will just be a big list of every account that we're using in the system. Not every company will use all of these assets, liabilities, shareholders' equity, revenue, and expense accounts. Okay? But they'll often use very, very similar names. Cash, short-term investments, trade receivable, note receivable, inventory, supplies. These are all very, very common words. And so for practical purposes, on the midterm, you will have to use a proper name. Okay? The entire course, we're going to be using the term trade receivable or account receivable. If you just put receivable, that's wrong. If I'm a dumb accounting system, I don't know what that means, okay? You have to think hyper-literal, meaning you have to be very specific in what you're saying, okay? So the chart of accounts, and you can look at this in accounting software like QuickBooks, it'll just give you a list of every account name and its unique identifier. So that if you're using the system for the first time, you'll know, okay, here's how I book something to the cash account. I need to use that cash identifier, okay? Nothing new here. This is how a statement of financial position looks. Notice assets on the left, liabilities, and shareholders' equity on the right. This goes back to the fundamental accounting equation. Assets on the left equals liabilities plus owners plus shareholders' equity on the right. Okay, there's a reason financial statements are set up in this manner. Statement of comprehensive income, or the income statement, revenues and expenses. Okay, principles of transaction analysis. So every transaction affects at least two accounts. You can have transactions that impact numerous accounts. If you don't believe me, try to think of a transaction and I'll tell you at least which two accounts it impacts. There is no such thing as a transaction that only impacts one account. If you say, well, what if the company received $10,000 in cash? Only cash goes up, right? Wrong. Where did that $10,000 come from? There's only a handful of places it could have come from. Could have borrowed the money from the bank. It could have received money from shareholders. It could have made a sale. Or it could have collected money from a sale it made previously. Right? If Walmart promised to pay us in 6 months, 6 months comes, Walmart pays us, we got $10,000 in cash. Each of those transactions will result in a second account being affected. Okay, there is no such thing as a one-sided transaction. There is always two accounts, minimum. After each transaction, the accounting equation will remain in balance. Again, I challenge you, you won't find one, to think of a transaction that will result in an imbalance, right? Where assets is now greater than liabilities and shareholders' equity, or less than liabilities and shareholders' equity. There's no such thing. By the way, the great thing about this equation is it functions like an equation. You can reword this. You can move these terms around. You can say assets minus shareholders' equity equals liabilities, right? Or assets minus shareholders' equity, or minus liabilities. Let's try that again. Assets minus liabilities equals shareholders' equity. Okay, so it gives you different ways to think about all these elements. Okay, so how do we balance the accounting equation? For every transaction, we need to follow these steps. The first step is to identify the accounts by title and make sure that at least two accounts change. So hypothetically, think if ePhone borrows $10,000 from the bank, what two accounts are going to change? Cash and bank debt. Classify by type of account, and that means, was each account an asset, a liability, or shareholders' equity? This isn't necessary. This is a very helpful learning tool because a lot of the accounts, you're not sure, does this go on the statement of comprehensive income or the statement of financial position or the statement of cash flows? So as you're doing the problems, if you work through and say, this is an asset account, this is a liability account, this is a shareholders' equity account, it will help you identify these accounts quicker, okay? Determine, okay, so in our example, what type of account is cash? Cash is an asset. What type of account is bank debt? That's a liability. Determine the direction of the effect. Did the account increase or decrease? So our bank account is going to increase when we receive $10,000 of loan from the bank, just like how your bank account increases when OSAP gives you money. But that liability account also increases. You now owe more money. Okay? The other thing to consider for assets and liabilities is their absolute numbers. It's kind of like weight. You can't have negative weight. You can't have a negative asset or a negative liability. That doesn't really make sense. Right? What would be, that's like antimatter, like what would a negative asset be? It's kind of conceptual. We actually are going to give an example of assets that offset other assets, but fundamentally, you can't have, if you have negative cash in your bank, that's bank overdraft, that's actually a liability, right? So when you're thinking about the direction, don't think of liabilities goes down. Liabilities increases and assets increase. Verify, okay, and then so step 2, verify that the accounting equation remains in balance. We're going to go through some examples of this, and I'll show you that after we record every transaction, the accounting equation will be in balance. That doesn't mean that the dollar amount of assets will remain unchanged. It could be $10,000, then $20,000, then $15,000, then $25,000. It's that the two sides will always be equal. Okay, but the absolute number of the equation will increase and decrease. Okay, let's go through some examples. ePhone issues $2,000 worth of additional common shares to new investors for cash. So let's say ePhone decided we need some more equipment, we're doing well, it comes back to us as shareholders and says we need more money. And we say, okay, that makes sense, we'll give you $2,000. So let's go to our steps. Identify and classify accounts and effects. So we know that the cash balance is going to increase, that's the easy half of the transaction. We know we need at least a second account. Remember from day one, what happens when ePhone issues shares? That's recorded as shareholders' equity or contributed capital. Notice how we're identifying plus A. Notice how we're identifying plus SE. Okay? So, and by $2,000, right? Now we have to check to make sure our accounting equation is in balance. Cash, $2,000. Contributed capital, $2,000. Contributed capital or common shares are a shareholders' equity account. Assets, cash, are $2,000. Liabilities and shareholders' equity are $2,000. The accounting equation is in balance. It's not a coincidence. ePhone borrows $6,000 from the bank, signing a 3-year note. 3 years. So what does this mean? 3-year is the term. Okay, and note is just another word for an amount payable, a loan. Okay. What are the accounts and effects? Our cash balance increases, but the amount of liabilities we have also increases, right? The bank, we owe the bank $6,000. Again, think of if you buy that house for $1 million, but you took on an $800,000 mortgage. Are you a millionaire? No. You own a house that's worth $1 million, but the bank gets the first $800,000 of it. You are only worth $200,000. So $6,000 of money is now owed to the bank, right? Regardless of how you use this cash. Let's look at the accounting equation. Cash increases by $6,000 to $8,000. Our liabilities increase by $6,000. You're not going to have a negative liability, okay? Our liabilities plus our shareholders' equity, $6,000 plus $2,000 is $8,000. The accounting equation is in balance. Next, ePhone purchases new processing and packaging equipment costing $10,000, paying $2,000 in cash and signing a 2-year note for the balance. This is similar to buying that house with a mortgage or buying a car where you might put some money down and finance the rest. This is an example of a transaction that has more than 2 accounts. Now we're impacting 3 accounts, right? So we received some equipment worth $10,000. We paid cash of $2,000, and we also made a legal promise to a third party to say we will pay you $8,000 in the future. Once you sign that document that says I'm buying the equipment from you and I'll pay you $8,000 in the future, that's a legal obligation, right? You will owe that money. So what happens? Cash goes down by $2,000, equipment goes up by $10,000. Now this is an example of the historical cost principle. Remember how I said transactions are recorded at their cash equivalent amount. If you as the owner, let's say, or one of the managers, let's say you're savvy at buying equipment and you think you got a great deal. You thought this equipment was worth $14,000 and you got it for $10,000. Are you allowed to record, even though you only paid $10,000 for it, are you allowed to record the equipment at $14,000? No. There's 2 reasons. One, the accounting equation wouldn't balance because you paid $10,000, but your assets increased by $14,000. The second is the historical cost principle says, what did you pay for it? You paid $10,000 for it, that's what it gets recorded at. That doesn't say that's what the market thinks is worth. That doesn't mean that's what you could sell it for today. It says this is what you paid for it historically, okay? So going back to this example, equipment increases by $10,000, right? What's the total of our assets? Cash is 2 plus 6 minus 2 is 6, plus 10 is 16. We have more liabilities. We increased our liabilities by $8,000. Our notes payable are now $14,000. These are to 2 different parties, right? We owe money now to multiple parties. One is the bank, the other is our supplier of this equipment. And the third component is contributed capital. Total is $16,000. The accounting equation is in balance. ePhone lends $3,000 to a supplier in financial difficulty. Not a very good idea, but still. The trade supplier signs notes agreeing to repay the full amount in 6 months. So before we're going with this transaction, remember, we're capitalists, right? We want to make money. We're not going to give money to anybody. So not only are we loaning this money to our supplier, if they're in financial distress, we're not going to loan them the money for free. We're going to say, there's a chance you're going to default and go out of business and not be able to pay me. I'm going to charge you interest. So we're not showing that example here, but we might be charging them 10% interest per year. So not only will they have to pay us back the $3,000, they'll have to pay us $3,300, right? We're going to make some money off this. So what are some examples? Or what's the classification of the accounts and effects? Well, our cash balance decreases by $3,000 because we're lending it to our supplier, but the supplier has legally promised us $3,000 in the future, okay? Because we're going to receive that money in the future, it's an asset. So our cash balance went down by $3,000. Our notes receivable went up by $3,000. Notice how this was just an asset movement. There was no impact on the right-hand side of the equation. But in this case, cash went down, notes receivable went up, assets stayed the same at $16,000. All right, let's say we have some excess cash. This is that example that I made with Apple, where they have billions and billions of dollars sitting in their bank account. So if we don't expect to need that cash anytime soon, well, there's a few things we can do with it. One is we can pay it back to us as shareholders. We can pay dividends, right? The shareholders will realize a return on that. We can pay back some of the debt we owe. We can make maybe an early payment. Say, bank, we're not using this money. You're charging us interest on it, so we might as well pay you back so you don't charge us as much interest. Or the third is we can reinvest in assets. Maybe we can buy some more equipment, but we, at this point, determine we don't need any more equipment. There's not enough demand. We can also purchase the shares of another company. We are allowed to go to a stock market and purchase shares of Apple. We might think Apple's a good investment, right? So we'll invest $1,000 in Apple shares. So what happens? Well, our cash declines by $1,000, but our investments increase by $1,000. Think of your personal balance sheet when you invested $2,000 in ePhone. Even though you don't have the cash in your bank account, you would look at your TD investment account statement and they'd say you have shares worth $2,000. That's an asset to you, right? It's not cash, but it's worth something. You could sell it to somebody else. Same applies for corporations. They're no different. Again, this was solely on the asset side, right? Notice how there's nothing here. The transaction was all on the asset side. The assets are still equal to the liabilities and owner's equity, shareholder's equity, okay? The board of directors, okay, so I might have discussed this last week, but what is the structure of corporate ownership? There's us as shareholders, okay? Problem is, there might be millions of us. How do we determine who gets to run our company, the management of our company? How it works is shareholders will actually elect a group of directors. They're called the board of directors. And there might be 7 or 9 directors. So you, as a shareholder, have the right to cast 1 vote per share, for example. And you get to elect directors who are usually experienced in the business. They're usually older. They usually, maybe they were a manager formerly of this company. We elect the board of directors, and the board of directors works for us. And they have our best interests in mind, okay? The board of directors doesn't manage the day-to-day operations of the company. The board of directors is now responsible. We've delegated authority to them to manage the day-to-day operations of the business, to hire to hire a manager to run the day-to-day operations of the business. The board of directors has say over if we're going to distribute dividends, if we're going to take on a lot of debt, if we're going to acquire another business, right? These big decisions that would impact shareholders. You go to your day-to-day, you have school, you have work, you can't be involved in Google's operations. The board of directors manages Google's operations on our behalf, manages our best interests, and they elect a manager who manages the day-to-day, okay? So the board of directors decides to pay $3,000 in cash dividends. pay $3,000 in cash dividends to the shareholders. Okay. So, and next month. So this is a kind of a complex transaction. So because we've promised to pay these dividends next month, we now have a liability, right? We're going to have to pay out the shareholders $3,000 in a month. Remember how your shareholders' equity is a function of the money that was put in plus all of the earnings to date. You have to back out dividends because this is the company saying you've earned to date, well, actually, they haven't earned any money, but of the $2,000 you put in, we're going to give you back some. Okay, we're not paying off any of the bank debt, we're paying off you. So this actually lowers the retained earnings of the company, or where am I here? You can't lower contributed capital by paying back, by paying dividends, okay? What's going to happen is when these dividends become paid, I wonder if that's the next one, no? What's going to happen is when these dividends get paid next month, we're going to see $3,000 less of cash, and this is going to decrease by $3,000, okay? So that'll cancel to go to zero. And the accounting equation will still be in balance. Okay, so the accounting cycle. This is getting back to some of the mechanics. We start a new period. We'll call this January 1st. We'll say 2017 is our new period. During the period, so right up until, let's call the end of the period December 31, 2017, we have to analyze transactions. We have to record journal entries in the general journal. These are words we're going to go over. And we have to post these amounts to the general ledger. What on earth does that mean? This is all the mechanics. Okay? This is the same way how you use Java or C++ to communicate with the computer to tell it how to do something in a very specific way. These are the mechanics. We record a journal entry and we post the amounts to the ledger. We'll show you how that works. The end of the period we don't cover until chapter 4, so that's next week. Okay, so we're going to go over examples of this. Every transaction, all I want you to know for now is every transaction results in an entry in the general journal. Once we've posted all of our transactions, once we've recorded all of our transactions, we take all the information from every transaction contained in the general journal and we post it to the general ledger. And the general ledger is made up of T accounts. Okay? The T account is called this because it looks like a T. And we'll show you how the mechanics work. Okay, we're going to keep going here. Let me just see what slide we're on. Okay, let's keep going here. Okay, we're going to introduce new terms, and this is actually this is the true fundamentals of accounting, okay? Debits and credits. These words are somewhat arbitrary in that the word debit has nothing to do with debt. It's not bank debt. It's spelled very similarly. Bank debt is D-E-B-T. A debit is D-E-B-I-T. Okay? Entirely different than debt. I don't know why they decided to call a debit a debit. So to say that the accounting equation always balances, assets equals liabilities plus shareholders' equity, is the same as saying debits equals credits. Okay, debits are always on the left. Direction is important here. That's why assets are on the left, because assets are represented by debits. And liabilities and shareholders' equity are represented by credits, and therefore credits are always on the right. So don't try to understand what the word debit and credit mean. You could use it as, you could pick any variable. You can call it X and Y, or left and right. Okay, so because assets have debit balances, if we say we debit an asset, that means we are increasing it. If we say we credit an asset, we are decreasing it. The reverse is true because you cross over to the other side of the equation. The reverse is true on the right-hand side for liabilities and shareholders' equity. These have credit balances, meaning credits increase these numbers, these balances, and debits decrease these balances. Okay, so how we'll talk, and this is how I'm going to talk for the rest of the term, is debits and credits. In the transaction where ePhone takes on $10,000 of bank debt, rather than saying cash increases by $10,000 and liabilities increase by $10,000, I'm going to say debit cash $10,000, credit bank debt $10,000. In an example where, let's say ePhone was owed money from Walmart. So if we had already shipped them the phones a few months ago, on our statement of financial position, there's going to be a trade receivable or an account receivable with a positive balance, a debit balance. When we receive cash from Walmart in payment of that account receivable, what happens? Debit cash, credit account receivable. We're crediting the account receivable because it's going down. It's an asset, right? So when you credit an asset, it declines. The reason why it makes sense that it's declining is because Walmart doesn't have to pay us twice. They pay us once for what they owed us, and that's it. You only have to repay OSAP once, right? You don't have to repay them twice what you borrowed. I mean, you have to pay them interest, but you don't have to repay the principal more than once, right? So we're going to be talking in terms of debits and credits. Okay, the T account, every account in the chart of accounts has its own T account. And the T account captures the cumulative impact, okay? So how it works is you'll see that the T account has a left side called the debit side and a right side called the credit side. Okay, you'll see here, here's a T account. We could call this cash. And anytime we debit cash, we put a number here. And anytime we credit cash, we put a number here. Another tip, you'll sometimes see debits, you'll sometimes see shorthand for debits, and I'll be using this because I don't want to write out the word debit, as DR. Not doctor, just DR. That's shorthand for debit. And you'll see credit, no surprise, CR. So you'll start seeing this shorthand, DR and CR, and the expectation is that you understand what that means. You understand how it'll impact the accounts. Okay, but we're still not there. So we know how to, we know if I say I'm debiting cash, crediting bank debt, that's helpful. You know what it means in terms of directionality, but we still haven't translated that information into the accounting system. So every account will have a T account. And you'll see for the assets, debits increase, credits decrease. Liabilities, debits decrease, credits increase. Notice how the debits are still on the left side, regardless of the fact that you're looking at, this is the same for shareholders' equity. Notice how these are all on the left side. Debits are always on the left. It's just the impact it has on the account is reversed. Either it will increase the account or it will decrease the account. But debits are always on the left. Credits are always on the right side. Okay. Even though credits increase liabilities and decrease assets. And credits increase shareholders' equity. Okay. Notice how debit's always on the left, credit's always on the right. You need to get that ingrained in your brain. It really forms the foundation of this course, because when I start to describe more complex transactions, I'm going to say debit X, credit Y, assuming that you understand what that means. Okay? This is just saying the same thing? Okay, so remember how I said, this is how companies keep track of account balances. The first step is to record a journal entry in the general journal. Historically, before computers, how would companies record financial information? There would be a physical book this thick with every transaction. So how do we record transactions in a way that is consistent? We have what's called the journal entry. These are important. On the midterm, you will be asked to prepare journal entries. Okay, so let's dissect this a little bit. Everything here is important. They will have a reference. Reference C. Okay, the reference is important because if you have 1 million transactions, you want to be able to reference what this transaction refers to. You might have an invoice and say journal entry 12. And then you can go to your general journal and physically flip to page 12 if you didn't have a computer. Okay, so this is to record that transaction where ePhone purchased property, plant, and equipment, and it paid in cash and a note receivable, or a note payable rather. Notice how we have the accounts, right? The account title, and we have debit. Notice how it's on the left side, and credit on the right side, okay? Notice how we identify the accounts being impacted. When we purchase equipment, we know we have property, plant, and equipment. We're paying cash for it, and we're also giving a note payable. We're giving a promise to pay in the future, which is a liability. Notice how we identify what's happening. An increase in assets because we're receiving this property, plant, and equipment. A decrease in assets because we're paying cash, and an increase in liabilities because we're promising to pay in the future. Very important thing to note, these are indented, cash and notes payable. Not a coincidence, credits are always indented on a journal entry. Again, think of if you're doing computer programming, you need to have indents sometimes or it doesn't understand what you're saying, right? The indent is read as credit. In fact, you don't even need to look at these column headers, debit, credit, because you see the indent for cash, and on the right-hand side is the amount. You know the cash is being credited by 2,000. Property and equipment, we're debiting it because the property, plant, and equipment is increasing. No indent. The 10,000 goes on the left-hand side of the column. And notes payable, it's a credit because we're increasing a liability. We put this 2,000 on the credit side, right? Now, for practical purposes, you do not need to identify plus A, minus A, plus L, but it's helpful to get your thinking going. If you're thinking, which direction is this account moving? Is that a debit or a credit? If you know cash is decreasing, fundamentally you know cash is going down because we're paying it. And think, okay, well, cash is an asset, meaning it has a debit balance. I know that my cash is declining. To decrease assets, I have to credit it. That's the line of thinking, okay? So indents are important. You must indent your journal entries on the midterm or you'll get the question wrong. Because if you don't have an indent, you're telling me that's a debit. Okay, and as many times as I say it, I still get quite a few students coming to me after the midterm and saying, I got all these wrong. And I said, well, because you don't have any indents for your credits. They said, I never knew I had to do that. Every example you ever see for a journal entry will have an indent for a credit. I'm telling you it's very important to have an indent for a credit. Okay? Your columns, you do not put all the numbers in one column. If you put 10,000, 2,000, 8,000, those are all in the debit column. Okay, your debits don't equal your credits. Your accounting equation will be out of balance. You have to have these visibly separated. Notice how the debits total 10,000, the credits total 10,000. Always. Your debits in your journal entry will always equal your credits. Yes, question? For the reference? Yeah, it was, sorry, do you mean like the... No. Oh, okay, good question. Okay, so... Yeah, exactly. So the question is, on the midterm, what will you have to be putting for account titles and references? Okay. How it's going to work is, notice how this is reference C. It'll be very similar. I'll have transactions labeled A to F or 1 to 7, and that should be the reference, okay? And the reason you do that is because you'll find sometimes you might know how to record transactions 1 to 4, and you won't know 5 and 6, and you'll do 7. So you might have 1, 2, 3, 4, 7, and then you'll figure out how to do 6, and then you'll figure out. It's hard for the TAs to mark that. If you have references, it's really easy to mark it. But practically, all journal entries need references, okay? So just get in the habit of 1, 2, 3, 4, A, B, C, D for your references. Account titles, you do not need to put an account number. I will give you or you should know the account titles, or I'll give them to you, and just use that account title, just the word. You don't need an account number because it changes from company to company, right? I might call property, plant, and equipment account 105. Someone else might call it 10,005. Someone else might call it 2,000. So it's just a unique identifier. Okay, so let's say we go through this process for all of our transactions throughout the year. Every transaction results in a unique journal entry. Here's a problem. If you had 10 of these transactions and I asked you, hey, what's the cash balance? You would have to go through each transaction with a calculator and say, okay, cash increased by 5,000, decreased by 2,000, increased by 1,000. You'd have to keep track of it. That's not very efficient, and it's in fact impossible to do, right? If you have 100,000 transactions, 1,000,000 transactions. So that's why we have the ledger. After journal entries are prepared, they are posted or transferred to each account affected by the transaction. The account balances themselves are kept track of in the ledger, in the general ledger. Notice how this journal entry doesn't tell me what the beginning or ending balance of cash was. It just says, hey, cash was credited by 2,000. It tells me the change. This would be like that line item on your bank account that says you went to Yi's Sushi and paid by debit for $20. It doesn't say how much you had before you went to Yi's. It doesn't say how much you have after. Okay? So journal entries are the transactions. The ledger reflects the balances. So how do you post a journal entry to the ledger? Okay, this is the next step in these mechanics. So here's another example. Transaction A. ePhone issued $2,000 of additional common shares to new investors for cash. So what happened? We debited cash by 2,000. We received cash. We credit share capital by 2,000. Notice plus A, plus SE. Notice the indent. Very important, the indent. Notice how the credit is also on the right-hand side. Debits always come first in entries, okay? Do not put a credit first and then a debit. That's hard to read and you will lose a mark. And that's not just because it's hard to read, but practically speaking, debits always come first. Notice how 2,000 debit equals 2,000 credit. Okay, so this is the journal. This down here is the ledger. And each of these is a T account. And each account has their own T account. This is the cash T account within the ledger. We have a beginning balance of 6,000, let's say from previous transactions. We now post entry A to the debit side. Notice how this is on the left-hand side. Cash goes up by 2,000. Our cash balance, our running total is 8,000. We could have many more transactions come through here and just keep a running total. It's a lot easier to keep track of the balance this way, right? If I had a credit, debits and credits are absolute, meaning on the credit side, I would not go bracket 3,000. I would just put a 3,000 here on the credit side. And we know that this is offsetting to the debits, okay? Share capital starts with a $1,000 beginning balance. Notice how this is on the credit side, on the right-hand side. We post this $2,000 credit, and we have a running total of 3,000. Now, the great thing about this is, imagine this was extended. you can have as many transactions as you want moving through here. And now you can keep a running total, right? This is how the accounting system works. This is how we tell the system, this is how we capture the information. First, we have to know what the transaction is. We have to record the journal entry, and then we post it to the ledger to see what the impact is on the account, so what the ending balances are in the accounts. More examples. Company borrows, so these are the same entries that we went through previously, and I was showing you without debits and credits and without journal entries and without the general ledger. The fundamentals are the same. This is more mechanical. This shows how we go from understanding the transaction to the impact on the balance. We first have to understand what the transaction is. We have to record the correct journal entry, and then we have to post, right? So here's our journal entry, debit cash 6,000 because we're receiving cash. Credit notes payable because we owe money to the bank. We post this 6,000 to the cash, debit, cash is increasing. We owe the bank $6,000 more dollars, it's on the credit side. If we repaid the bank $5,000, that would be a debit and a credit here, right? Do not put negative 5,000 here, even though that's the impact, and do not put negative 5,000 here because this is an absolute number. That's like negative weight. Doesn't make sense, right? So here's a great thing. It's possible to create a statement of financial position. You can look at what your asset and liability and shareholders' equity balances are at any point in time. Once you've recorded all these journal entries, you could look at today, May 8th, and say, okay, we've recorded everything from January 1st to May 8th. Let's post it all to the ledger and see what the balances are. Let's see what the T accounts come out with. Okay? This was the only way to do it for many, many years. Actually, when I was an accounting co-op student, there were some of our clients who still had manual handwritten ledgers. And I had to go through it to understand what was happening and tie in the numbers and make sure that it all made sense. So this actually, up until not too long ago, people still did it. I mean, people who are old school still like to do it this way, but they're few and far between. And soon enough, it'll just be people doing it on QuickBooks, which is software. But this is how it works fundamentally. Okay? Nothing new here. Current and non-current. This is for your assets and your liabilities. Current is going to be used within a year. Non-current is going to be used for more than a year. Here's how a classified statement of financial position looks. We always start with current assets first and non-current assets second. And these are ranked by liquidity. Cash is the most liquid. We're calling, inventory less liquid than trade receivables. Liquidity just means how soon do we expect to receive this in cash? Well, cash by definition is already received in cash, but we expect to receive these trade and other receivables in cash before we sell this inventory for cash. Okay? The liability side of the statement of financial position follows the same logic. Current comes first, then non-current, ranked in terms of when we expect to pay it. We expect to pay these first, and then provisions, and then our income taxes, and then our short-term borrowings. Okay, remember how we talked about liquidity? So if you had a $2,000 credit card bill and you only had $1,000 in the bank, but you had a house worth, and you had equity in the house at $200,000, do you have a problem? Well, yes and no. You have positive net worth. You have a house worth $200,000. Well, your share is worth $200,000. Plus you have $1,000 of cash, $201,000 of net worth, less the credit card bill you owe, $2,000. So your net worth is actually $199,000. Great. The credit card company needs their money tomorrow, and you only have $1,000 of cash. That's a problem. Where are you going to get that from? It takes a long time to sell a house. Or you need to go to the bank and say, can I borrow against the money in my house? That takes a long time. You have to go to a friend and borrow $1,000, right? Companies run into problems of liquidity. Liquidity just meaning you can't meet your short-term obligations. Your long-term obligations, you still have positive net worth. You still have shareholders' equity, okay? That's called solvency. So the current ratio is a common measure you'll see that compares the company's current assets as a ratio to current liabilities. Notice how it doesn't have a dollar sign because it's units. Dollars divided by dollars cancels out, right? If ePhone has current assets of 48 million and current liabilities of 30 million, it has 1.5 current assets for every current liability it has in dollars. So that means it's in good shape. It can repay its current liabilities, right? The reason why we look at current is because this is all happening in the same time frame over the next year, right? Current assets and current liabilities are both classified based on a year-long system. If the current ratio was 0.5, that'd be a problem. That means we owe, for every dollar of assets we have, we owe $2 of liabilities in the short term. We're going to run into problems with being able to pay everybody, right? Okay, let's take a break. It's been a long time, and it's been an hour and a half. Let's be back by 8:10, and we'll keep going, okay?